Hello everyone, my name is Zach and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. The very first tax optimization that you need to know about and that you should probably be taking advantage of is tax loss harvesting. Okay, so what this is intentionally selling an investment at a loss so that you can realize a tax deduction for it. You can get a tax deduction for a loss that you have on your investments. Keep in mind that this only applies in a regular taxable brokerage account. This is not going to apply to an individual retirement account, a 401k, or any other tax advantage account. However, in this particular situation, I'm not talking about selling at a loss because you made a bad investment. I'm only simply talking about selling at a loss in order to basically exchange one of your funds for another. So specifically, I'm referring to when you're investing in like a broad-based stock market index fund. Now, the way that you can take this and make it to your advantage is that you can exchange, basically sell something and buy another one of a similar but not substantially identical asset. For example, if you have an index fund and it is temporarily showing a loss because the market is down, like we have a temporary market downturn, then you can sell that at a loss and then buy a similar asset that is going to probably track in the same direction. However, it can't be substantially identical, meaning the new fund that you buy can't track the exact same index. Now, why would you even want to pursue tax loss harvesting? Well, tax loss harvesting can help offset any kind of capital gains that you made. Investment losses can offset capital gains, but also it could possibly offset up to $3,000 of ordinary income per year. Now, you can realize more than $3,000 of losses per year, but they must carry forward in other years up to $3,000 per calendar year, like per tax year. The way that you as an index fund investor can benefit from this is, let's say that you have a total US stock market index ETF, such as VTI. Well, if you are showing a loss, a paper loss temporarily with VTI in your taxable account, you could sell it and realize a tax loss. And then you could buy VOO, which is Vanguard's S&P 500 index fund. These two funds track very similarly. That means they go up and down pretty much at the same time in almost the same exact rate. However, they do not have the same index. The S&P 500 has, a little over 500 stocks in the index, while the total US stock market index has, depending on which index it is, like 3,500 or more total stocks. And the same can be said with many other funds and many other indexes that you might be investing in. Let me go ahead and put on the screen real quick a cool little chart from the Bogleheads wiki page that shows some funds that are good for exchanging with each other, but they aren't substantially identical, so they don't fall into what's known as a wash rule with the IRS. This is not meant to explain tax loss harvesting in its entirety, and you do have to be careful, and there are plenty of other considerations that you need to make if you're going to pursue tax loss harvesting. But if you do your homework and you have a good understanding, it could be a small optimization, a small tax optimization that could be very beneficial for you in the long run. And very similarly to tax loss harvesting, number 2 here is tax gain harvesting. It is a lot less talked about, but I think it's actually easier than tax loss harvesting. Tax gain harvesting is where you intentionally sell an asset and you can rebuy the exact same asset to realize a capital gain. And so you're purposely saying, hey, go ahead and tax me on this gain. I just sold it, I realized a capital gain, and then you went ahead and immediately bought it back. There's no problem with that. You're just going to be taxed on that gain. But the magic here with tax gain harvesting is that you can reset your tax basis. You can purchase something at a higher price, get taxed on the difference, and be taxed at 0% with the current long-term capital gains rate. Depending on your filing status, you can get capital gains at 0%, which we basically are not paying any taxes on those capital gains. This generally is going to track with the regular income tax brackets, where if you're in the 10% or the 12% marginal tax bracket, then the equivalent for the long-term capital gains rate is going to be 0%, and above that is going to be 15%. So you can strategically realize long-term capital gains at 0% if you have some room to fill in that tax bracket. This allows you to lock in that 0% tax bracket. So there's a lot of wiggle room in there for you to reset your tax basis through tax gain harvesting. You probably want to do this because that means that you'll never have to pay capital gains taxes on the investments that you own within a taxable brokerage account. Because keep in mind, this is also only applicable to a taxable brokerage account. And if you keep your tax basis high, that means that you can possibly never pay income taxes as long as the capital gains rate remains 0% for certain income levels. And I just have to keep a really important note here for you. These optimizations, they are by no means required. Okay, they can complicate things a lot and they can make a big big difference over the long run, but they could also overcomplicate things, and it's just not 100% necessary to do any of these optimizations. What is necessary are just some few simple steps that you need to take to change your behavior and make sure that you are consistently investing. And I do have another video for that, like a full guide to investing, but let's talk more about that later. Let's get on to the next optimization here. The next optimization is where you keep investments that produce a lot of income that could potentially be taxable. More specifically, what I want to mention here is having bonds and having REITs, real estate investment trusts. These you probably do not want to keep in a taxable investment account at all if you can avoid it. And the reason is because these produce a lot of taxable income that can be taxed at ordinary rates, which is a lot higher of a tax than, let's say, long-term capital gains. For bonds and for REITs, you most likely, if you 100% can, keep them into retirement accounts or other tax-advantaged accounts. Why? Well, that's because if they pay out income, like bonds pay you interest, those kinds of income are going to be taxed at the ordinary tax rates. And those tax rates are going to create what's known as a tax drag on your investment performance. That's basically why you would want to keep investments that produce a lot of taxable income in tax-advantaged accounts where you're not going to be realizing that income and you're not going to be paying taxes on that income. And did you know that there is an investment that is never taxed as ordinary income? The investment of hitting the like button on this video. You're never going to have to pay taxes on all this information that I'm giving you here. So isn't that great? Please hit that like button if you're enjoying this video so far, because not only does it help me out, and I would really appreciate it, but it also can help you out as well. Now let's get on to number 4. And number 4 has to deal with where you want to put international funds. More specifically, how I'm always talking about if you're investing in index funds, if you have an index fund that tracks international stock markets, this is where you want to put that. The best answer for this is going to be it depends, okay? Just like with every single thing when it comes to personal finance, the answer is always it depends. But as a general rule, if you don't have a very high amount of income, then it might be better for you to keep international funds in a regular taxable account versus a retirement account or a tax advantage account. Where if you have a higher income, it might be better for you to keep the international funds in that tax advantage account. And the reason for this is that international funds, like international companies, they pay taxes to foreign governments. And you as an owner of that international company means that you by default are paying taxes to foreign governments. And you, if you're in the United States and you file a federal income tax return, you can go ahead and report that you paid taxes to the foreign government, and that could qualify you for the foreign tax credit, which basically is a tax credit for the amount of taxes that you paid to foreign governments. Now, this does not apply if your international funds are in a regular tax advantaged account, like an IRA, because there's no tax consequences for that anyway, so you can't claim a foreign tax credit. But if it's in a taxable account, then you're going to receive a form from your brokerage company, and sometimes that form is going to say you paid this amount of taxes to foreign governments. And so you would put that on your tax return and you would qualify for a foreign tax credit in many circumstances. However, at the same time, international funds, like international companies, tend to have higher dividend yields, especially if you're investing in the international index. So having a higher dividend yield, which means you're going to be paid higher dividends. And that's where the benefit of whether your regular income is higher or lower comes into play with where you take your international funds. Generally speaking, if you're in the lower income, it might be more advantageous for you to keep your international funds in a taxable account. And if you're on the higher income side, it might be more advantageous to keep the international funds in the tax advantage account. Now, here comes some thoughts where I want to hear from you in the comments below. What other investment optimizations are there that haven't been mentioned in this video that you think that a lot of people could be taking advantage of? If you know of any other optimizations, please let me know in the comments below. But before you go, I do have one more for you, and this next optimization is specifically investments within a Roth account, like a Roth IRA or a Roth 401k. A good rule of thumb for an optimization is to keep your highest potential growth investments in your Roth accounts. So if you have, let's say, generally speaking, small cap stocks, like if you invest in small cap stocks specifically, generally speaking, they are more volatile and therefore they probably have a higher potential for a large amount of growth. If you have a specific thing that you're investing in that could have the potential for a lot of growth, you generally want to keep that in a Roth account. That's because in the future, if it does grow to be a very large amount, you don't have to pay taxes on that. So that means that your capital gain that you make with your high growth investments, your high potential growth investments, are going to be tax-free for you in the future. Now, the reverse of that would be like an investment that does not have high growth potential. You would maybe want to keep that out of your Roth account. So let's say, for example, your bond allocation. If you have a portion of your investments specifically for bonds, like you have an 80-20 stock to bond like ratio for your investment allocation total, you probably don't want to keep any bonds in your Roth account. If you had a traditional IRA, maybe you'd want to keep your bonds in the traditional IRA preferably, because you are going to pay taxes on the amount that you would draw from your traditional IRA in the future, but you're not going to pay taxes on the money that you would draw from your Roth IRA in the future. That is how you kind of want to structure where you keep your investments within your total asset allocation plan. And while I'm really glad you stayed to the end and learned about these tax optimizations, I do want to make sure that you know that there is, the 80% that you should be doing before you even focus on this, 20% of how you should be handling your investments. And that is why, if you have not already, you need to watch my full guide to investing your way to financial independence. Okay, that video is going to pop up right on the screen right now after I get off the screen. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.